There's certain sectors in the investing world that you definitely want to have a little bit more of within your portfolio because there's a couple that are there that can just shoot off into the moon. The only problem is picking the correct stock within that sector is really hard to do. That's why I like specialty ETFs or sector ETFs for this option. When investing and building out one's portfolio, I do hope that you understand that just like most things, it's important to have a good healthy foundation first. The foundation I'm talking about would be a broad index ETF like VOO, the S&P 500, or VTI, the total US stock market. One could definitely spend a bunch of time and effort building an awesome house with all the best research materials and finest decorations, but if they build it on sand and a storm comes, that whole thing is getting washed away. So after this video, make sure and check out my video on the 3 fund portfolio that I use as my base, but let's get into this one today because it's definitely going to be a fun one. In this video, I'm going to go over my thoughts and the research that I've done on 1 or 2 ETFs within these sectors: AI, healthcare, real estate, infotechnology, financials, and energy. Now, as a real live professor in my day job, every single one of my students is excited for and interested in AI, especially those that didn't know that I knew what ChatGPT was and turned in some super sus looking papers. But anyway, AI is an amazing tool and it's here to stay, so the first 2 ETFs are going to be from this sector. Now the first one in this sector is called AIQ, and that's the Global X Artificial Intelligence and Technology ETF. And in my opinion, this is the best overall in the artificial intelligence sector. For a broad AI play, investors can buy AIQ, which tracks INDXX Artificial Intelligence and Big Data Index. The top holdings in AIQ include familiar big tech names like Meta, Nvidia, Tesla, Microsoft, Alphabet, Apple. These companies all stand to either develop or use AI further in their products and services and tend to be less risky of an investment than up-and-coming small-cap AI stock. The current price is $23.56. They have an impressive 5-year appreciation at 11.5% per year. The expense ratio is 0.68%. Now, side note, these specialty ETFs, and especially the newer hot type ETFs like AI, are going to have a higher expense ratio. So make sure you take that into account when you look at their returns and make sure that it makes sense for you to put this into your portfolio. 0.68% is very high. It's much higher than what I like to have in my portfolio as far as an ETF, but there are some ETFs in here that I do like even despite a higher expense ratio than I'm used to. The assets under management for this fund is 134 million. Year to date, they're up big at 17.16%. And one interesting fact that I do like about this ETF is that it has weightings from companies outside of just the United States, so that helps diversify your portfolio a bit too. The issue that I have with this one specifically is that it's very highly weighted in companies that are already in the S&P 500. So if you do have that foundation like I was talking about before and you have a high weighting in the S&P 500 or other large cap ETFs, you probably already have exposure to most of these companies. So this next one might be a little more intriguing. And that next one is called BOTZ, B-O-T-Z. And that's the Global X Robotics and Artificial Intelligence ETF. And it's obviously huge in AI and robotics. To capitalize on both trends, investors can buy BOTZ, which tracks the INDXX Global Robotics and Artificial Intelligence Thematic Index. The global robotics market was valued at more than $55 billion in 2021, with forecasts suggesting it could nearly double to $91 billion by 2026. This one has a current price of $25.11. Since inception, it's brought about 9% appreciation per year. It does have a high expense ratio like the one before at 0.69%. The assets under management is 1.7 billion, so quite a bit bigger than the one before. And year to date, it's up crazy high at 21.6%. Now, BOTZ has a higher allocation to industrial and healthcare companies, highlighting the increased application of AI and robotics in those sectors. So I really like this ETF for the diversification because it has a lot of companies that you're not seeing in things like the S&P 500 or other mainstream ETFs. The types of companies here are unique, and once again, I really like the diversification this brings to one's portfolio. Now, the next sector is healthcare. And as far as healthcare ETFs go, this one is the best one that I found, and it's just so strong in so many areas. And this one's called XLV. One of the biggest ETFs of any flavor, XLV is a more than $41 billion sector fund that ranks among the top 30 or so US listed ETFs by assets. So if you understand that healthcare is just a great thing to have in your portfolio, this would be the safest and most popular ETF. So this helps bring a lot of safety and consistency to your portfolio. Healthcare is definitely one of the most recession-proof sectors, so I really like it for when there's a down market. XLV is a diversified play on this big picture trend, including 60 leading US stocks such as insurance giant United Health Group Inc., Band-Aid and Tylenol manufacturer Johnson & Johnson, and big pharma mainstay Merck & Co. The current price is $135.05. Year to date, it's very flat, down only negative 0.3%. The expense ratio is 0.10%, which is finally a nice expense ratio. Now XLV has a very impressive 5-year and 10-year. The 5-year is at about 11.6% appreciation per year, and the 10-year is at over 12.7% per year, which beats the S&P 500 and many other funds. This is the breakdown of the actual types of healthcare industries and segments that one is invested in within this fund. And as you can see, it's very spread out from pharmaceuticals to equipment and supplies to biotechnology. The consistent, strong returns coupled with that low expense ratio makes this one of my top ETFs in the sector space for sure. Now for this next category, I'm going to give you 2 ETFs like I did at the beginning, because for this sector, it's just too close to call. And this next category is going to be real estate or REIT. Now, this is one of the most popular sectors for sure, and I really like this, especially if you are adding it to VOO or VTI, because both of those ETFs have very low exposure to real estate or REITs. One of the best REIT ETFs out there is from Vanguard, and this one is the Vanguard Real Estate ETF VNQ. The expense ratio here is 0.12%. Its 5-year and 10-year are both pretty consistent at about 5.8% appreciation, which is solid growth. This ETF is very big with a market cap of $22.6 billion. VNQ has a current price of $82.06, and year to date it's down negative 0.61%. Something to keep in mind is that most dividends from REITs will not be qualified dividends, which means they'll be taxed higher. In general, real estate investments are better suited for the Roth IRA for these reasons. The next ETF in the same sector is SCHH, and that's the Schwab US REIT ETF. The fund's goal is to track as closely as possible before fees and expenses the total return of an index composed of US real estate investment trusts classified as equities. The expense ratio for SCHH is 0.07%. The current price is $19.27. Year to date, it's at negative 0.05%. The 10-year is 4.5% appreciation per year, and the dividend yield is over 3%. Now, SCHH's top positions include PLD, AMT, and other unconventional real estate plays to give investors full exposures to the sector. My favorites in this fund are Realty Income Corp. O and BICI. Now this next one is a fun one and always a fan favorite, and this is information technology. And I like this one a lot for this sector because it's different than a lot of other ETFs that I like within this growth type play. And especially in technology, AI, VR, a lot of these smaller companies now are going to turn into huge companies very quickly with this technology. So this ETF is the Vanguard Information Technology ETF VGT. And as you can see, it has a very low expense ratio of only 0.10. The fund employs an indexing investment approach designed to track the performance of the MSCI US Investable Market Index Information Technology 2550, an index made up of stocks of large, mid-size, and small US companies within the information technology sector. They have a bunch of companies we know and love, like Apple and Microsoft, but when you look further down their list of holdings, it's clear that VGT offers a deeper look at the sector. And this is one of my top reasons why I absolutely love this ETF. Now, the thing that most people really like about this ETF is their performance, because it is off the charts. VGT has a 10-year appreciation of over 19.4% per year. It has a market cap of $37.89 billion. The current price is $376.53, and year to date it's tearing it up at over 19%. I know many of you already invest in this one, and I can definitely see why. This one should continue to smash for years and years. The next industry that's probably smart to have exposure to in your portfolio is financials. The Financial Select Sector SPDR Fund XLF is yet another mega-sized ETF on this list. It's made up of some of the strongest and largest financial institutions in the US, with their top holdings including Warren Buffett's Berkshire Hathaway, JP Morgan Chase & Co., and Bank of America Corp. Part of the reason that XLF is so popular right now is because rising interest rates tend to benefit financial institutions like these that hold a lot of assets. While small and mid-sized financial institutions are kind of going through some crazy times right now, the largest companies in this sector are actually just getting stronger. The current price here is $33.14. Year to date, they're down 3.44%. It has a very low expense ratio of 0.10%. The assets under management is $31.8 billion, and it's had a pretty solid and consistent growth with nice appreciation of over 10% every year for the past 10 years. Like I said, financials have definitely taken a little bit of a dip with the whole SVB collapse and with rate hikes going up and inflation and all of that. But in general, finances and financial institutions aren't going away anytime soon. And while it's really hard to pick the absolute winner, an ETF that has all the big ones is probably a very smart move. The next sector is energy, and this is another super fun one. For this one, I'm going to pick a green focused energy ETF, but first, just a bonus for you here. A really good broad fund for energy in general is XLE, which is the Energy Select Sector Fund. But again, a lot of this is represented in the S&P 500, and it's pretty focused on fossil fuels. So for this section, I'm actually going to suggest more of a green and renewable energy type fund, because I think that that's more where we're headed in the next 5 to 10 years. Many financial pros are recommending clean energy ETFs because that's where most expect to see the biggest growth. A good pick for broad clean energy exposure is QCLN, which tracks the NASDAQ Clean Edge Green Energy Index. The index deploys a screener to target companies involved in the following clean energy themes: advanced materials, energy intelligence, renewable electricity generation and renewable fuels, and energy storage and conversion. The current price for QCLN is $48. Year to date, they're up 4.71%. It has an expense ratio that's a little bit higher, but not as high as the first ones at 0.58%. Its returns are actually quite surprising. For the past 10 years, it's had an average appreciation of about 17.5%, which is insane. It holds many monsters in the industry like Tesla and First Solar, but also ON Semiconductor, Enphase Energy, and Lucid Group, which will bring much diversification to one's portfolio. I like this one so much as a sleeper that no one knows about because it already has a history of crushing it, and that's before these companies really start going and taking that market share that governments are going to definitely be incentivizing even more, because clean energy is definitely the future. Most investors should definitely still stick to broad-based index funds for the majority of their portfolio, but adding in one or two of these from before could definitely supercharge that portfolio. Make sure and watch this video next to keep working on that road to financial freedom.